In chapter 5, we're going to learn how to understand the story that the financial statements are trying to tell us. So we're going to look at the raw numbers on the financial statements, and we're going to compute some ratios, which help us to understand how one number relates to another number and when that relative value is of some use to us. And we're going to look at those relative measures over time and compare them to other firms. And we're going to look at these numbers from the perspective of financial managers, other business managers, creditors, and investors. So we have different categories. We're going to be interested in the profitability of the firm, its liquidity, which means how much cash it has and its ability to raise cash on short notice, how much debt it has, whether it has too much debt, and surprisingly enough, perhaps the question, does it have too little debt? You might not have thought of that as a question that one would ask. We're going to look at the different categories of assets and see how productive they are. And we're going to also look at the market and how it reacts to the firm relative to certain key accounting variables. So in the profitability category, the first ratio is the gross profit margin, gross profit over sales. So how much of the company's sales revenue is being eaten up by cost of goods sold. So you can see the two numbers come from the income statement. And this particular company has 39.7% of its revenues left over after we have accounted for the cost of goods sold. Next, we have the operating profit margin, where we are digging a little deeper into the income statement. How much operating income does the firm have relative to its sales? We see that for this firm, it has 22.8% of its sales revenue left over after we've accounted for cost of goods sold, other operating expenses, and depreciation expense. Next, we have the net profit margin, which tells us that we have 11.2% of our sales revenue left over after we have subtracted all the expenses incurred by the firm. And so the gross profit margin, operating profit margin, and net profit margin all give us slightly different perspectives on the question, how profitable is this firm? Next, we get into a different kind of profitability ratio. This is in the category of what we call a mixed ratio, because it mixes two different financial statements, the income statement and the balance sheet. So this particular firm has net income that equals 6.4% of the amount of its total assets. Some firms are very asset intensive, such as a manufacturing firm. And so the denominator would be very large and this number would tend to be small. There are other companies, such as consulting firms, where the denominator total assets is relatively small, and this ratio would be expected to have a much larger value than you'd see for a manufacturing firm. Return on equity is another ratio that we have an interest in. We're studying the firm from the perspective of its owners. So how much net income does the company have relative to the owner's investment in the firm? And we can see here that net income is equal to 9.53% of the common equity. Next, we're going to move into an analysis of the firm's liquidity. Does this firm have the ability to meet its short-term financial obligations? These are the ones that we probably worry about the most. the rent that's due next month is probably more on your mind than the loan that's coming due 10 years from now. So we have the current ratio, which equals current assets over current liabilities. So what we can see here is that this particular firm has 5.35 times, the X stands for times, the amount of current assets as it has current liabilities. So this is a measure of the cushion by which the firm has cash and near cash assets, which are current assets, relative to those liabilities that are coming due soon. Next, we have the quick ratio. And the difference between the current ratio and the quick ratio is that the numerator has inventory subtracted from it. So the numerator is all assets except for inventory, and the denominator is the same as it was for the current ratio. And so for this particular firm, it has a quick ratio of 2.63 times. This might be a useful number to look at for a firm which has inventory which is not particularly liquid. Say you have a manufacturing firm that has a large percentage of its inventory goods in the process of production. You wouldn't be able to sell those partially manufactured goods very readily, and so if you looked only at the current ratio, you would get a false sense of the liquidity of the firm. Next, we move into the debt ratio category. So the debt ratio is simply your total debt. That would include your short-term and your long-term debt. Current liabilities are short-term debt. This firm is 33% debt financed. That tells us by definition that's the other 67%. That would get us up to 100% total. 67% must be equity financed. Here's the debt to equity ratio, just another way of looking at the relative debt load that a particular firm has on its balance sheet. Here's a very different type of debt ratio. It comes from the income statement. Times interest earned. This is sometimes also called the interest coverage ratio. So you can see that operating income over interest expense is 5.5 times. We have 5.5 times the amount of operating income that it's going to take for us to subtract the next item on the income statement to be subtracted. That would be interest expense. Asset activity ratios. Average collection period. Do we have a good credit policy? Are we extending trade credit to customers who are going to pay us back on a timely manner? And so here you can see that we have the average account outstanding gets collected in 108.24 days. That's the number we get when we divide accounts receivable by the average daily credit sales. The average daily credit sales is the total sales divided by the number of days in the year. So that number seems fairly high. If your credit terms were net 90, that is, you requested that your customers pay you within 90 days when you send out the invoice, this would clearly be an area of concern. If, on the other hand, you're a furniture store that offers customers 6 months to pay, that would be a low number in that context. How about inventory turnover? How efficiently do we convert our inventory into sales? This firm here converts its inventory into sales 2.3 times per year. And again, whether that's a good number or a bad number depends on what kind of company you're talking about. If this were a very capital intensive company, and it was a company that didn't rely on its inventory so much. This might not be a surprising number. If you had a company which was very reliant on its inventory, such as a grocery store, you would expect that number to be very much higher than 2.3 times, because what we're measuring here is how smart we are in the selection of our inventory. Are we generating the kind of inventory that people want to buy? If so, we put the inventory on the shelf, we sell it, we restock, we sell it, we restock, we sell it, and that would give you a very high inventory turnover. If, on the other hand, you're in a business where the inventory does not convert into sales quite as quickly, let's think of maybe a music store that sells pianos and musical instruments. Those kinds of companies with that kind of inventory are going to have a lower inventory turnover. This is a more general ratio. We're looking at the fixed asset turnover ratio. And so we can see that this company is converting its net fixed assets into sales 1.12 times per year. And so this is a measure of how wise we are in purchasing the kinds of fixed assets that we have. You have to remember, fixed assets would include equipment, but it also includes your physical plant. And so clearly your physical plant is going to take longer to justify its existence relative to sales than a new piece of equipment is. So these are the kinds of things we'd be looking for. And here's just the big picture. We have the total asset turnover ratio, and so looking at all of our assets, how readily do we convert them into sales? And for this particular firm, it's 0.57 times per year. And once again, this relatively low number would be what you would expect for a very asset-intensive business. You would expect it to be higher for a firm that relied more on, say, its intellectual capital than on the assets that it put on its balance sheet. Let's move on to our market value ratios, and the price to earnings ratio, more typically referred to simply as the PE ratio, is the market price per share of the stock, which is given here as $20 per share, divided by the earnings per share. So we take the net income and divide by the number of shares outstanding. This is 12.35 times. So the market is willing to pay $12.35 for each dollar worth of current earnings that the firm is generating. Clearly, anyone who buys the stock at $20 per share today is buying the entitlement to future earnings, which do not show up in this particular ratio. They couldn't. Here's the market to book ratio. So once again, we take the market price of the stock per share in the numerator, and the denominator is common equity over the number of shares outstanding. Let's just call that equity per share. This firm has a market to book value of 1.18 times. This is a relatively low number. It might be what you would expect to see from a company that relies very much on the assets that it has and not so much on its intellectual capital. A firm which was a growth company and that had value as a going concern based on the new products that were being developed year after year after year, that company might be expected to have a much higher market to book ratio. Every once in a while you see this number less than 1, like a 0.6. And if the book value is a good estimate of what the assets are really worth, you occasionally run into the situation where you have a firm that's worth more dead than alive. and the firm would liquidate itself in that case and sell off all the assets, pay off all the liabilities, and distribute what's left on a per share basis to the stockholders. Okay, I am going to skip here a couple of the slides. The others are fairly self-explanatory. And I want to talk about something called economic value added, or EVA. This is the amount of profit earned after subtracting all the costs, including the cost of the funds incurred by the firm. And it is often seen as the measure of true economic profit as opposed to the accounting profit that we've been discussing up until now. So equity has a cost, and so that cost gets factored into the EVA computation. And so we're going to look at this a little bit later in the course. But for now, we can simply say that the cost of all the funds is of concern to the firm. A related measure is the market value added, or MVA. This is the market value, not the value on the balance sheet, the market value of the firm, its debt plus its equity, minus the total amount of capital invested in the firm. And so this gives us a feel for how the market is viewing our debt and our equity. And if the market has bid up the price of our bonds and our stock, that's going to give a higher MVA. So a company that consistently invests in projects with high economic value added values is going to have a high market value added number. Next, we're going to look at how certain ratios interact with one another and why it's important to understand those interactions. They give us some very useful insights as to how well the firm is doing and why it does what it does. The first one is called the DuPont equation. This was created by an internal financial analyst who worked for DuPont Chemical. He made the observation that the return on assets ratio that we looked at earlier is equal to the net profit margin times the total asset turnover. You can see that mathematically it's pretty straightforward. If I take net income over sales, which is the net profit margin, and multiply by sales over assets, which is the total asset turnover, then sales in the denominator here cancels sales in the numerator here. I'm left with net income in the numerator uncanceled, and assets in the denominator uncanceled, and that's my return on assets ratio. So a firm could have a high net profit margin and a modest total asset turnover ratio, such as a jewelry store, and have a reasonable return on assets. Another firm, such as a grocery store, might have a very small net profit margin and a very high total asset turnover. And when those two numbers are multiplied together, the grocery store too may have a reasonable return on its assets. The jewelry store and the grocery store get to that return on assets figure in two very different ways. Finally, we have the modified DuPont equation, which picks up where the DuPont equation left off. We can see that return on equity is equal to the net profit margin times the total asset turnover times something called the equity multiplier. So each of these is defined down here. Net profit margin and total asset turnover we saw in the regular DuPont equation. So there's your net profit margin, there's your total asset turnover ratio, and the equity multiplier, which is new to us, is the assets over equity ratio. And so if you multiply those three ratios together, We have sales in the denominator here, canceling sales in the numerator here, just as we did in the regular DuPont equation that got us to return on assets. So these first two ratios, when multiplied together, give us the return on assets. And when we then subsequently multiply by the asset over equity ratio, the equity multiplier, we have assets here canceling assets here. We're left with equity in the denominator, uncanceled, and net income in the numerator, uncanceled. And so you can see here that your return on equity is a function not only of your return on assets, but also the way those assets are financed. Are they financed largely with equity, in which case the denominator of the equity multiplier would be large and the overall number would be small, and we would have a smaller return on equity? If you were to have a firm with only a little bit of equity, that means by definition that firm has a lot of debt, and with a small amount of equity, you have a smaller denominator and a larger number, and a larger value for the return on equity, assuming that the return on assets was positive. So the thing here is that this equity multiplier multiplies the return on assets in determining the return on equity, and the equity multiplier multiplies the return on assets in both the positive direction, that is, it makes a positive return on assets more positive when you move to return on equity, but it also multiplies in the negative direction. If you had a very high equity multiplier and you were multiplying this large equity multiplier by a negative return on assets, it would make the return on equity more negative. So that's it for Chapter 5.